One day I woke up and I thought, maybe this is not the future of finance.
If you're, just thinking about the DeFi ecosystem, you're never going to scale. So, how can we get enough yield and continue to scale with like the unlimited amount of borrow demand? A lot of that, we have to untap all that stuff from off-chain, right? And bring institutions to come and create this.
People are not used to composability.
No,
they're not used to I have this asset, now I can lend against it, I can swap. That does not exist in traditional finance.
And that's what we're all aligned in, having them understand that, by virtue of tokenizing an asset, you actually unlock composability and you unlock new primitives.
But you really lose people because they don't understand the concept of composability because that's never existed.
Welcome to DeFi Drip podcast.
Thanks.
We're actually reviving this from, I believe, a few years ago. So there are in the annals of history, some pretty cool conversations to kind of look at, which was the old DeFi Drip, but very happy to be bringing it back. But yeah, it would be amazing if you guys could both introduce yourselves and Cap in a few sentences.
Nice. Well, hi, I'm Benjamin, founder of Cap. Here we have Weso, our CTO.
Yeah, founding member
as well. Before starting Cap, I mean, we're all DeFi people, right? We all believe that the future is decentralized finance, non-custodial, this intermediating finance. But one day I woke up and I thought, man, we're building all this stuff that's in a circular economy. All the yield comes from its own kind of bubble, from Bitcoin-backed lending, from basis trading, from inflationary tokens. And I thought, maybe this is not the future of finance. Maybe we've all developed used up all of our careers to push this thing. And at the end of the day, it's just not going to get adopted. And then I thought, okay, if anyone's going to do it, why not us? Why don't we just think about how to connect these tools to the productive economy? So that's kind of the nexus of Cap. How can we connect the productive economy to these on-chain markets? As a high level, Cap is an insured private credit market. And what we're really solving here is how to allocate capital to institutions so they can borrow from us unsecured and generate yield for our users, but do it in a way that doesn't sacrifice the strong values that we have in crypto of verifiability, of protections for users, of safety. And so we've built this engine in order to allocate the capital to these institutions.
So I guess I hear allocate capital to institutions with crypto guarantees. I'd love to get a sense of who you're currently working with, who you're getting a sense of maybe working with in the future, and maybe give the listener a bit of a, sense of who that could be and what you have in your mind as well, because I think that's pretty interesting how we're seeing new faces there.
Yeah, so Cap is a three-sided marketplace. We have depositors that bring dollars and they come because they want to earn yield. We have borrowers that come because they're getting unsecured credit from us. And then we have underwriters. And the underwriters are the ones that choose who get to borrow, and they choose by deploying collateral as guarantee for whoever they're choosing to let borrow. And so they bear the risk of their default, but they also get their premiums from them borrowing. Now you ask, what are the institutions? What are the institutions that are working with us today? Well, for example, on the deposit side, we've been able to convince some regulated asset managers to connect us to their users. So you have a deposit at WisdomTree, you can put it in Cap, and now you're earning yield from our protocol. So that connection is something interesting that we've been able to create. On the borrow side, we have a lot of institutions that would have never borrowed from crypto before. They don't use Aave, they don't use Morpho, they don't use anything, right? But they realized that they can get loans at a similar rate than they would borrow from Apollo. And they can do so in the same way they borrow from Apollo, it's unsecured. And so they're very interested and they've come on chain for us and now they're borrowing. Some of these include Susquehanna. They're a $900 billion AUM HFT firm, so no small company. IMC Trading, Flow Traders. So these are regulated, very large institutions that are borrowing from us. Finally, your underwriters, right? We have underwriters, and these are the guys that are choosing who gets to borrow, and they're vouching for the credit of these institutions. So far, we have a lot of Bitcoin token issuers. We have a lot of restakers, every single major restaker, and a lot of these major Bitcoin bridges. And we want to continually expand that. So we actually want to work a lot with the RWAs, because at the end of the day, underwriters are just asset holders that have assets that are less productive than the dollar. and they come to underwrite dollar loans in exchange for a premium that they would have not had access to otherwise. And so think about any sort of RWA that you can provide. Gold, like the commodities are pretty easy example, but also alternative fiat currencies like dirham, Japanese yen, etc.
We're obviously seeing people with all different types of like borrow demand coming on chain and utilizing Cap. I also think we give access to, right now we're like utilizing like Bitcoin and ETH maybe as like underwriting collateral, but like there's opportunities now to do RWAs in that space, tokenized equities, debt. Like there's all types of opportunities now to use different layers of capital to underwrite the credit side. So right now it's Bitcoin because Bitcoin has like a lower premium that it demands compared to some other assets. But I mean, like, we're expanding that asset base, and then we're seeing a lot of like different borrow demand than we probably initially expected, or things that the people who are coming to us that want to borrow are definitely outside of the zone of what we originally thought, which is really kind of cool and good. And
so initially I thought maybe we would have a lot of market makers,
of course,
and MEV players because they want to borrow fast, they want to borrow and they can pay a lot. But in the end, we have a wide variety. So we have term loans, which means people that borrow a lot and they borrow for a long time. We have revolving credit facilities, meaning you have a credit line, but you draw on it just when you need it. We have payment financing companies, so large Web2 fintechs, like buy now, pay later type of companies. We have inventory financing companies. We have a manufacturing plant in Boston that's borrowing from us because they want to finance their inventory. And so really it's the whole scope of what the productive economy can bring is what we're getting. And we thought it would take us years to get to that point, but it seems to be a bull market for traditional institutions coming on chain. Every single one of our borrowers are KYB'd. We know who they are. They have legal agreements to repay. The collateral that's placed is a last hope, right? Guarantee in case really everything goes wrong. And because of that context, the type of assets we can take are a bit wider than if you're permissionless blockchain, permissionless borrow lend market, where any sort of actor, even North Korea, could be using your platform.
I think most of what we built came from Ben's mind about like what was wrong with like stable coins in the past. Scalability, huge problem, especially yield scalability, right? And if you're just thinking about the DeFi ecosystem, you're never going to scale. So how can we get enough yield and continue to scale with like the unlimited amount of borrow demand? A lot of that we have to untap all that stuff from off chain, right? And bring institutions to come and create that. And obviously the cyclical yield. If you're in one category, then that yield might go away, at least in points in time. So we want to be able to be diversified in that lens. And then also the insured yield, making sure that if you're stable or you go ahead and put your dollars in, you're expecting a yield, and you don't want to be able to, like we've seen so many different stable coins like blow up, right? You give it to a provider, they make bad decisions, they lose the money. So instead, we give it to somebody to go create yield or do whatever their strategy is, or borrow it and use it for whatever. But being over collateralized, from the underwriters, it's ensuring the liquidity, the US dollar depositors. So it's taking in all of the perspectives of things that maybe were wrong in the past with how stablecoin design was made, and protecting, especially those who are entering in the stable side of the three-sided marketplace.
Yeah, I can definitely see how this kind of protects the stablecoin side. I guess I'm curious about how you see users organically like screening risk as they come in with their own collateral to go and guarantee these opportunities. Do you expect underwriters to do this on behalf of users?
So we think that we should never put users in a position where they need to interface the institutions because they have no idea how to do that. And so we have the role of the underwriter. The underwriter will never be retail. It's institutions that have the means to go after the other institutions. So if Liberty Mutual underwrites KKR defaults, Liberty Mutual can sue them, right? You and I, we have nothing to do with KKR. We won't be able to scare them, right? It's just a different, basically you're picking a fight with somebody your own size.
Does this happen at an individual borrower level, or is there a way to also kind of underwrite across many borrowers for someone who might be looking for like wider diversification?
The loans are one-to-one. We're creating sort of a new segment, right?
Of course.
Cap itself is a piece of innovation, and so, a lot of the asset issuers that were, or like people who were creating Bitcoin products and stuff like that, were getting a lot of risk-free yield. Well, that's going away. Pretty much already gone away. So they need to kind of innovate and they need to change, and so we're kind of forcing that, right? You need to get into the risk management, risk assessment sort of industry. So it's either these protocols change and they start to understand how to analyze and manage risk, or there's a new crop of protocols that start to do that.
The one thing you said earlier is you're seeing a lot of borrow demand, and it almost sounded organic. I think from my perspective, right, like looking into these things, it's always the bottleneck. Like it's actually what I would have assumed is really hard to scale. It sounds like it isn't for you guys, which is fascinating to me. So I would love to understand this better.
I mean, I think unsecured borrow is like probably the easiest side of the marketplace.
Okay.
It's like the one with the most demand.
Yeah, I mean, sourcing good borrowers is hard.
Right.
We've been lucky to get them. Yeah.
Yeah, but I think the matchmaking of like underwriters to borrowers is a little bit of a process still, right? Being a young protocol and trying to like show people this new opportunity and how it functions. And so I think what we've seen is that sort of like a word of mouth thing happen with borrowers as well.
It's good to be on chain, and it's not for decentralization's sake. It's actually also very efficient. If I want to get a loan from Apollo, I need to get in line, because every single loan goes through the same team. So if they need to underwrite 10,000 loans, have fun, right? You probably need to have a bigger loan. There's a lot of things that come into it. At Cap, we have an unlimited amount of underwriters. You don't need to convince all of them. You need to convince one.
Yeah, that's true.
And so it's way more efficient for underwriting loans as well. I would just say that like there's always borrow demand, right?
Of course.
The largest market in the world is unsecured borrow of dollars. And that's going to be here whether Bitcoin's at $1 million or whether Bitcoin's $0. And so we were always going to have borrow demand at Cap. I think the issue we have in crypto is that it all revolves around Bitcoin-backed lending. And so that's why you have Aave at 2%, right? Because nobody's borrowing against their Bitcoin right now. We don't really care. I mean, this protocol works without Bitcoin. It works without any of those markets, right? As long as the smart contracts are still live and Ethereum is still running, we can function.
You're seeing like real traction today. I'm curious, like, forward facing, like, do you see innovation coming from just scaling this existing model, and you think like the current model is really solid? It's just about finding more use cases under borrows, more types of assets as loan assets, as collateral assets within the system, just scaling the underwriters and doubling down on this exact structure? Or are you thinking about technical improvement, economical improvements that might make this, scale in a different way?
I think we're learning as we go, right? So, we introduced the system, and we got a lot of feedback from both the underwriters and the borrowers. So we take all that feedback. After the first run is done, we're going through V2 improvements. Maybe creating like tranching systems, looking into fixed rates, things that have been specifically requested from each of the stakeholders. Just continuing to improve it and making it more flexible to what they desire and what they need. So I don't think that ever stops. Honestly, it's always continuing to like innovate and to build whatever's going to help us grow. I think obviously scaling, right now it's just we have Bitcoin and ETH as delegated assets. So I think like, the real unlock would be, doing some RWAs and stuff like that as underwriting assets and stuff like that. So we're looking at all of that, but it's a continuous process.
If you guys could pick any asset to go and tokenize and use as an underwriting asset, like what would it be?
It would be credit default swap obligations.
Credit default swap obligations.
I think there's just a world of loan insurance outside of what we've created, and we're looking to expand to that. But we need on-chain representations of those in order for it to work with our system. And so that's, I think, super interesting.
Okay, we'll chat more about this.
I think equities, so like tokenized stocks and stuff like that, and bringing those as opportunities. I think that there's like large positions of when people would like love extra yield on top of that.
People are not used to composability.
No,
they're not used to like, I have this asset, now I can lend against it, I can swap. That does not exist in traditional finance.
And that's what we're all aligned in, like, having them understand that by virtue of tokenizing an asset, you actually unlock composability and you unlock new primitives.
But
and
you,
I
like, you
agree
really
that,
lose people because like
you do
it's
lose
just like
people
they
after
don't
giving that
understand
pitch.
the concept
Yeah.
of composability
Yeah.
because that's never existed.
I'll give you an opportunity to maybe tell people where they can learn more about Cap and get access to really good resources, because I think you guys have some of the best out there in terms of like getting right information to the market. And so, yeah.
If you want to learn anything about Cap, just go to our website, cap.app, cap.app.
Nice. Well, great place to be. Thank you,
Awesome.
guys.
Thank you.
Thanks for having us.